Hello, welcome to another video of fitrends.com along with dubainews.tv. We have come up with a new video today which is talking about or taking on a matter which is very different from what we've discussed in the last 6-7 videos. What we want to discuss today is also important for financial independence, but doesn't directly deal with wealth creation as such. I was told last year to write for a local newspaper and the business section about in personal finance to look at how should people manage their liquidity. And that is why, and in fact it becomes very important as we go along, and particularly in terms of economic conditions and the stressful economic conditions that we're going through today, the liquidity management takes utmost importance. We in this particular video are going to share with you some practical suggestions which are not new to you. I'm sure all of you know about it, or many of you might follow part of it, but to do it in a disciplined manner, I think hopefully this video becomes a kind of a reminder for you that this is stepwise. If you follow this process, it would be a great way to go towards our financial independence. Today we are going to consider the 7 different ways or 7 different steps that we should consider to manage our liquidity better. I think this will help you as a reminder if you want to consider as to how to follow 7 easy steps which could help in that process forward. As a first step, I think it's important that all of us know our income and expenses well. Now, what does a personal liquidity means? A personal liquidity means you should be able to meet your current expenses as well as your near-term expenses with the cash that you have and any assets that can be very easily liquidated in the short term. And going into that, I think it's very important for us to know the relationship between these income and expenses and how to manage that process. I think that is going to be a big help for us to consider while managing our liquidity. Now, once we have established the relationship between our income and expenses and how that's going to work, I think the second most important step would be to create a contingency fund. It's utmost important for all of us to create this fund for the rainy day, or we can say the rainy day fund, which basically would mean that we have to save enough to make sure that we meet our basic expenses for the next 10 to 12 months. And that can be achieved by making sure that our income every month is divided into basic expenses and into investment stream, which will help us in a good position. If we today, tomorrow need that money, it can be used for a 9 to 12 months. If you suppose lose your job or you don't have a job, it can help you in that process. And it's not very difficult. You just have to put in a goal, a short-term, long-term goal, and then break it up month-wise into different investment stream and the basic expenses that you have. The third most important point then comes in is for us to identify our liquidity needs. Now, when we say liquidity needs, we can divide it up into 3 parts. I do that. Primarily, the first one is the monthly expenses that are very important for you, known as the basic expenses that you need to have. After that comes expenses that unexpected events lead to, comes from unexpected events, such as your healthcare needs. Sometimes you might fall sick, you might need money for that. The third category comes discretionary expenses. Now, this is where you could potentially save or decide how much you need to spend, which is basically could be for your entertainment, holiday expenses, and the various investment stream that you need to build for your rainy day fund or your long-term goal of a pension, etc. Once your liquidity needs are identified I think the next step is to have the right investment mix of your investments. Now that can also be broken down into different categories, but before that I must say that please, it's very important. I have been telling that in many of my earlier videos. Financial education is very, very important for all of us. And there are many online courses, short courses, which are available on wealth management, managing your personal finance. I think all of you should take a small course just to have a basic guideline on it. Now, the investment mix is very important here because that would determine that we can meet all our needs for the next 9 to 12 months when it's needed, and also a long-term plan, which could have a SIP on one side, but also should include your life insurance policy, your healthcare medical expenses, as well as a long-term pension plan that you should work on. Once we have identified the investment mix, I think it's important for us to go for a diversified portfolio of assets. So when I say here diversified portfolio of assets, it is important because we might have a short-term need, we might have a medium-term need, which could be 2 to 3 years, and we might have a need which could be 5 to 10 years. And our investment mix in that has to be in that particular manner. So starting from, say, cash deposits, that you have a current account deposit in a bank, to a fixed deposit, annual fixed deposit, or a 5-year fixed deposit, moving on to money market funds. All those are different liquid investments apart from our healthcare policy that we talked about, or the pension plan that we talked about earlier, or a life insurance policy that we talked about earlier. I think these are all different asset allocation mix that is important for us to focus on. In that, we should also look at having certain physical assets, which are also very important. And in those physical assets, I think we're going to look at least having a basic necessity, which is to have a home. That is important, and we talked about how important that is in our previous episodes. I think at the same time, we should look at having some physical assets like gold, or any ETF which is based on such physical assets as well, which potentially could be liquidated at a much faster rate than a physical asset. And this is, I think, would help us to have a much more better optimal mix of assets portfolio within our investment mix. I think the next step is for us to identify what are the costs that are involved if we have to liquidate our assets. Because at the time of need, we will certainly need to liquidate these assets, and there are certain costs involved with this. For example, if you have a residential property and you have to liquidate in a short term, you know that it's very difficult to get a buyer for a property and particularly in stressful conditions, it becomes much more difficult. You can sell out your gold or other physical assets, but there will be a steep charge to it. At the same time, you might have a fixed deposit or a money market fund that we talk about. You could liquidate, or stocks that you have, you might be able to liquidate, but there will be a price fluctuation every day in those financial assets. So it is important for us to understand the financial implication and the cost of liquidating these assets while we are investing into them. So you have it in mind, and you have that calculated, that this could be the potential liquidity charges that we might have to pay. Lastly, we should all know how to manage our money position. What does that mean? That means it would be nice if we can maintain some good relationship with at least with a couple of banks or a couple of online fintech firms or online brokerages, where we can, in the current conditions where everything is moving to online, where we can buy and sell assets at a much easier way at the least cost possible. And it is important for us within that process to have, say, pre-approved overdraft limits, a pre-sanctioned loan, or having a very good credit card history. All these are going to be helpful for us when we are in need of liquidity in a stressful economic condition. And if we have that, and all that can actually be achieved by just a little bit of effort in setting those things up, and it will be helpful for all of us in going a long way in achieving the financial independence that we're looking to achieve. But we can all these 7 steps that we talked about can only happen if we are being proactive and go on to follow this process and start implementing the different ideas that are given here in this video, or that you see on the internet, that you read through, or through your personal experiences. But it's important that proactively we follow the process right. Before we end our video, I would again like to mention, like in my previous videos, that we're trying to create a community of professionals who can share their learnings and experiences through videos and podcasts. And if you have and you're interested to do that, you could send those to us at hello@5trends.com, and we would like to then publish it on our website and try to make it popular.